Hey everybody, Brian Bogner, Greg Towner here, Parallel Portfolios, and we're going to attempt to answer a very important question that I know is on everyone's mind right now, which is, are we in a bear market? Okay, we know that the S&P 500 is down over 20% year to date, and we're getting a lot of calls, and there's a lot of concerns about stocks right now. So why don't we go ahead and dive right into this? I'll go ahead and turn it to you, Greg.
Okay, great. Thanks, Brian. Yeah, like you said, we're hearing a lot about bear markets, recessions, which we'll get into later. We always like to start with this 3-year chart of the S&P just to kind of get a picture of what's been happening. Of course, we all know things were great for a couple of years coming out of COVID there from a stock market perspective. Terrific uptrend. Clearly, we all know that's changed here in the last handful of months. A lot of different reasons for that we can get into and we've been talking about for months now. Clearly, the trend has changed here in the short term. Whether you want to call it a bear market or otherwise, I think it's important sometimes to kind of zoom out and look at the longer term picture. This chart goes all the way back to the 1950s. So you can see there's a lot of different periods where the market did great, a lot of different periods where it went sideways, essentially. Those are the bear markets. I mean, they don't feel good for sure. A lot going on there. There's rallies, big rallies during them. But in hindsight, I mean, for example, think about the 1987 market crash, the biggest one-day crash in market history. You can barely even find it on this chart. So bear markets are difficult, they're painful. There's a good chance we're in one right now, but under the surface, there's a lot of things going on, including opportunities to invest.
Right. Yeah, and I think it's very important, just like you say, Greg, to look underneath the surface, because what this chart here is, we took all the sectors in the S&P 500. Okay, there's 11 of them. And we said, okay, well, the S&P 500 is down 21%. What about all the sectors? And this pink one right here is the S&P 500. So there's 4 sectors that are doing worse. And, guess what? Those were the sectors that were doing best over the last, 10 to 12 years, technology and consumer discretionary and things like that. But we've got 7 sectors here that are doing better than the S&P 500, and some, like, of course, energy's up big, right? That's the lone gun here. But the other 4, or the other ones here that are doing better, you've got some great sectors and great areas to participate in, whether it's industrials or consumer staples or materials or some things like that are actually doing well. So when we talk about the market, it's real important that we don't just say, oh my gosh, every stock is in a bear market. Oh my gosh, everything is down. No, it's not. And I think this chart also illustrates why it's very, very important that you have active management and that you have a strategy and you have a process in place, which we do here. We talk about this all the time on our videos, our QRLT process, right? Quality, rules-based, liquid and low cost, and tax sensitive. We use that process, and that allows us to shift and move and do things to help manage through these volatile and turbulent times. Okay, so shifting a little bit away from stocks, I think it's also important we talk about interest rates. This is the 10-year yield on the 10-year note, which really drives kind of all the interest rates that we have here in our economy. And as you can see here, this is going back to the late 90s, early 2000s. You kind of see the downtrend. We've really been on a downtrend in rates since the early 80s. Okay, so we're talking almost like a 40-year downtrend in rates. And we are of the belief that we are bottoming. We're finally bottoming here, and we're seeing I think, Greg, you said earlier, what we're reading about, or like a regime change in rates. Like it will be changing. So this idea that low cost of funds, cheap money, all this other kind of stuff, it's probably not going away tomorrow. Okay, I mean, if you really think about from a historical perspective, yeah. 3.4% on the 10-year is certainly high than what it was, a couple of years ago, but that's not at all, how would I say, that's not at all like, historically, that's still pretty low. Okay, so we're probably will still, be on the lower side, but we do think rates are changing, and that's significant, and it affects all the areas of the economy as well. So the other question we've been getting a lot of is about, are we in a recession as well, or is that coming? So Greg, why don't you talk a little bit about that?
Yeah, there's definitely a lot of talk about it. If we have a recession, it'll probably be the most predicted one ever, right? Everybody assumes we're in or going to be in one, and it's certainly possible. There's no question that's possible. But from our perspective, we want to think about what it means from an investing standpoint. So these dark bars on the bottom are what the stock market did during past recessions. And we can see in the far right, the average decline was about 29%, the median 24. Obviously, there's some periods that were much worse, but we're kind of looking at the averages here. What we know is that we don't know when that trough will occur. Maybe it's already occurred, maybe it occurs, months or even years from now. We don't know. What we do know is it's not going to feel good at that time. It's not, you're not going to feel the all clear of like, oh, inflation is no problem, interest rates are no problem, the war is done, supply chain is fixed. When all that is fixed, the market will have already done what we see above it there, the purple and teal bars. It will already have gone substantially higher in those first months and years after the eventual trough. So for investors trying to time things or wait until the coast is clear, so to speak, the market is forward looking. We're already down over 20%, so you could argue it's already factored in at least a potential chance of some of the recession. So the market's forward looking. When you get the all clear signal in the world, the market will have already factored much of that in.
Right. All right. So, are we in a bear market? The market's down over 20%. I mean, technically we're in a bear market right now. What does that mean? We tend to go back to 08. No, it doesn't mean that the market's going to decline and waterfall decline and we're going to lose 50% or things like that. What it means is we're likely going to be in a bit of a slog here going forward. And bear markets can, typically they kind of go sideways. You get these big volatile moves up and down. Again, this is the time you want to have active management. But look, the long-term trend is still up in stocks. Even when we look historically at those bear markets, the long-term trend is still up. We want to focus on that long-term plan, have a very disciplined process. We talk a lot about dollar cost averaging, smooth returns and emotions. We talked a little bit about interest rates too. That secular trend in rates is changing, which is going to affect everything. Okay, there's no more cheap money out there. Okay, but the main thing that we want to get to you in this video is that if this volatility is causing you concerns, maybe sleepless night or something along those lines, give us a call and talk with us. Let's go over your allocation. Let's go over your strategy. Let's make sure you understand the things that we're doing and that you're comfortable with that so you can sleep better at night. You always know how to reach us. You can call us, shoot us an email. Thank you so much for watching today. Have a great day.